skyrocketing right now. How much longer can this, be sustained? All this debt. Is it possible to continue on with this another 5, 10, 20 years?
Well, that's the big question, isn't it? Most of the stats out there now scream blow off top. The ones you mentioned, like the savings rate is plunging, which means people are spending money and putting it on their credit cards. They're borrowing money in order to spend a lot. So the headline number is usually consumer spending is up. Like that's a good thing without anybody in the mainstream media going into the details to see that people had to borrow the money in order to spend it, which means it's a self-limiting process. You can't continue like that, because your debts blow up your life if you keep borrowing it. And, consumer debt is at levels that historically have blown up people's lives. Same thing with corporate debt, all-time record levels, and still increasing dramatically. And, of course, government debt. Governments are now borrowing more as a percentage of GDP than they were a decade ago or a decade and a half ago. It's not like we're getting our financial house in order in any sector of any major economy. We're all making the same mistakes, but on a bigger scale. When you double the amount of debt that you control or that you owe, and then keep increasing it at the same percentage rate from there, you're taking on bigger and bigger numbers. And that's what the world is doing. The U.S. government doubled its debt during the Bush administration, which means George W. Bush borrowed more money than all the previous presidents in history. Then Obama came along and did the same thing, doubled the national debt over what Bush had done. Now we've got President Trump doing something similar, as being really fiscally expansionary, where they're cutting taxes and they're paying for the resulting deficits by borrowing money. And they're increasing spending on things Republicans like the military, and borrowing that money too. And a lot of it we're borrowing from China. Our trade deficit with China is soaring lately. So however you slice it, we are, based on historical precedents, at the blow-off top of another financial bubble. Now, the question this time around, though, is it different? As you said, can we keep on going like this for longer than we have been able to do in previous bubbles, because of all the central banks that are now doing experimental stuff with monetary policy? They're creating huge amounts of new currency. They're buying back financial assets, whether stocks or bonds, depending on the central bank, with that newly created currency. And that is presumably letting this thing go on a little bit further than it would be able to. And the question is, how far can it go? Can central banks keep this up forever? Can we just dispense with the whole idea of, valuation measures for stocks and debt levels for consumers and governments? Is all of that irrelevant now because central banks are just creating so much new currency and can do so basically to infinity, because the currencies that they're creating are basically just play money. It's not real. The dollar isn't based on anything. So you can have $10 trillion outstanding, or you can have $100 trillion outstanding in the economy, and it doesn't really necessarily mean much of anything. Now, I suspect that that's not true, that there are laws of economics and finance that can be bent but not broken. And after you take on a certain amount of debt, that debt blows up on you. That debt ruins your life and changes the way you live, just because the interest costs associated with that debt eventually come back to bite you. Now, you can force interest rates down to extremely low levels for certain amounts of time, but then that causes other kinds of imbalances. And, I think we're dealing with kind of a whack-a-mole situation now, where one imbalance pops up and the government addresses it with easy money, and then that causes something else, pressure to be released in some other part of the pressure cooker, and then we have to deal with that. Eventually, the thing will blow up. But whether it's this year or 5 years from now, that's really the question. And what happens in between? There are some people that say that the bond market will be the thing to blow up first. Other people are looking at stock valuations and saying that will crash and bonds will do well. It's hard to know exactly how this plays out, because it's, to a large extent, uncharted territory. But I think it's a pretty safe bet that there's a crisis of some sort in the next couple of years, and it's related to all the debt we took on in the last decade.
When you look at the economy, I mean, when we look at certain statistical numbers that are coming from the Fed, from the government, and we look at what Trump has done compared to Obama, compared to Bush, it looks like they're all following the same track because unemployment, I mean, is down to 4.1%. Now, when Obama was president, everyone was out there saying that, these are fake numbers. I mean, this is part-time jobs. This is not, they're not counting those people who aren't looking anymore because, right now the labor participation rate is at 62.7%. So when you look at these numbers like unemployment, the labor participation rate, GDP, are we doing the same exact thing? Has anything changed to really believe these numbers right now? Or are they using the same calculations back during Obama's time?
We're using the same calculations. We're still looking at an unemployment rate that doesn't include all the people who've gotten disgusted and stopped looking for work. And if you did include them, the number goes way up. We're not at full employment until the labor participation rate goes back up to somewhere near where it was, and the quality of the jobs that people are getting returns to what it used to be. In other words, decent paying factory jobs for people who are now bartending or waitressing or something like that. And, we're a long way from that, which is why the Fed feels justified in not just, hitting the brakes monetarily right now, because they're looking at the labor market and saying, okay, it's not nearly as good as that one headline number implies. So we do have a little bit of slack in the economy that you wouldn't expect from just a 4% unemployment rate. But at the same time, we've got so much debt in the economy. The people who have had to take crappy jobs or who have just dropped out of the workforce are presumably piling up tons of debt. All students basically are piling up tons of debt. The amount of student loans that are outstanding now keeps growing, and it's now higher than credit card debt. It's over $1 trillion. Auto loans continue to grow too. So in a lot of very specific sectors of the economy, debt continues to pile up, which, that's a sign on the one hand of slack in the economy because people aren't making enough to actually cover their lifestyles. On the other hand, it's a limiting factor in the sense that people can only borrow so much. And if they've borrowed more than they normally should be able to already, you can't expect debt-driven growth to continue going forward. So we've got a lot of cross currents right now. And most of it comes back to the fact that we've just borrowed way too much money. When you borrow too much money, your life gets complicated and messy and potentially disastrous. That's how it works for individuals, and that's how it works for countries. And if you go back to 1971 and look at the chart of debt that we've taken on at every level of every major society since we went off the gold standard, we broke the final link between the dollar and gold, and therefore between the rest of the world's fiat currencies and gold under Richard Nixon in 1971. Since that time, debt has just risen steadily year after year after year because governments were basically handed an unlimited credit card along with their fiat currency. And they've just been abusing that privilege, the privilege to make unlimited amounts of new money with no repercussions ever since. So we're at the point now where some kind of a monetary reset has to happen, right? We owe so much more money than we can ever pay off that the only solution to that, and this is history again, because governments have done this quite a few times in the last couple of thousand years, the only solution is to replace today's money with some new kind of money. Either you devalue your currency by some really extreme amount so that your debts, which are still denominated in the old currency, are easy to pay back. In other words, if we cut the value of the dollar in half, we still owe the same number of dollars, but the dollar is worth so much less that it's easy for us to pay back the debt that we've taken on. The whole world has to do that. And exactly how they do that and what the repercussions are of that aren't clear. So that's what we're dealing with going forward, is that we've basically run out of wiggle room with the current set of monetary policies. That is, with a fiat currency that governments create in unlimited quantities and then turn around and encourage people to borrow huge amounts of money in order to cover the debts that were taken on by the government. That process has to end at some point in the not too distant future. And it'll probably end via some kind of a monetary reset where we either devalue all the big fiat currencies against gold and go back to a gold standard, or adopt the special drawing rights of the IMF, or go to Bitcoin or something like that, where we no longer have to pay our bills in this expensive currency that we've got now. We'll have a cheaper currency that maybe gets us through. That's going to be really disruptive. And I think that's the big investment play going forward, is navigating this and positioning yourself so that you make out when the big fiat currencies of the world fail. And that's not an easy proposition because, as I said, there are so many cross currents. Do you short bonds? Do you go long bonds in that kind of a situation? Do you short stocks, or do you short just one category of stocks? What about other currencies? Do you want to just short the euro? You could do that. I don't know. There's a combination of stuff that you can do, or do you want to go long gold and silver and just stay off the monetary playing field while all this is happening? So there's a combination of stuff that you could do to prepare for this. It's not clear exactly what the perfect combination is, but I think some variation on all the things that I just mentioned. Some set of investment strategies that involve betting against the big fiat currencies and betting on real assets that will benefit in a monetary reset. I think that works. I think people will make a lot of money doing that going forward. But right now, the intellectual challenge is timing it right. Should we do it now, or should we do it in 2021? And getting the exact combination of those things right. And that's not easy. Nobody will get it perfectly, but a few very high-profile investors will do that, and they'll be the guys like the ones who were profiled in The Big Short after the housing bubble. We'll have a new set of those guys who make life-changing money by betting against the current system. And it would be nice to be one of them.
But this time it's going to be a little different because of this reset. And what about those people that, who have pensions, those people that have their money, that just sitting in the bank, and they're very nervous. They don't want to do anything. They don't want to go to cryptocurrency. They don't want to go to gold and silver. They think that, everything's going to be fine. If I keep my dollars in the bank, I have my pension, and everything will be fine. It has worked out, every single time in the past. It will work out this time. If we are going through some sort of reset, or they have to devalue the dollar and they're bringing in or ushering in a new currency, what happens to those people? Because believe me, there's a lot of those people out there.
Yeah, when a system breaks down, the people who have trusted the system are the ones who are the victims. And that's happening already. Somebody who saves a big chunk of his paycheck, puts it in the bank so he won't be a burden on his kids and so he'll be able to retire well. He's being screwed by this system today, because interest rates are so low and financial asset prices are so high, which benefits rich people who already have a ton of stocks and bonds, and it hurts small savers who are trying to get started and trying to put some cash away. So we're already disadvantaging these same people. But when the monetary reset is probably not here much sudden, because all of a sudden your bank account is going to be worth, half of what it seems to be today. And that's going to have to be a surprise announcement, because you can't do a monetary reset. You can't do a big devaluation of your currency and signal ahead of time that you're going to do it, because then everybody front runs you and kind of short circuit the process. So you have to announce it on a Friday afternoon or a Sunday night or something like that. And so that Monday morning is when all the banks open with bank accounts that are now worth half of what they were, and the stock market adjusts and the bond market adjusts, and you're stuck, and if you've been counting on a pension, you suffer dramatically from that kind of a process, because pension plans are going to be the big victim of this, and people who depend on pensions will be a big victim of it, because they are already grossly underfunded, state and local public sector pensions in particular. And so there's no way that even in an equities bull market and a bond bull market like we've had right now, there's no way, even if that continues, that they will be able to pay off what they've promised to pay off. So there would have to be huge cuts in pension payouts going forward, even in the absence of a financial crisis and a monetary reset coming, and it's going to crush pension funds. You know, Chicago's pension fund, for instance, for its teachers, let's say, is already so underfunded that those teachers are never going to get that money. They might get half that money that they expect. But that's in a pretty good environment for financial assets. Once the stocks and bonds that are owned by Chicago's teacher pension fund tank, and the fund goes from being, let's say, 50% funded to 30% funded, then, you know, it's basically over for these guys who are retiring and thinking they're going to live comfortably on their pension, because it just won't happen. That money doesn't exist, and it'll evaporate even further going forward, you know. And so these are the people who have lived their lives correctly. They played by the rules. They've saved their money. They've stuck with the job long enough to be vested in a nice pension, and they're the ones who are going to be punished by this. So it's really despicable what the governments of the world have engineered, but there doesn't seem to be a way out of it. There doesn't seem to be a pain-free from all the debt we've taken on, and you know, question of timing and details. You know, will it happen right away, or will we have to wait a while? And when it happens, will governments do specific things to specific people, or is it just going to be this across-the-board crisis? We can't know that, because it's going to you're sitting around conference tables and frequently, you know, cracking under the pressure and doing really irrational things.
Now, we see the Fed has been looking at inflation and they've been telling us that there's been no inflation. I mean, we see it in food, we see it in college tuition, housing prices. They've offloaded the inflation to other countries. Now we see some inflation, and you wrote an article that that inflation is much higher than the Fed is actually reporting. Now, why are you saying this? Why is inflation much higher than what the Fed is actually saying right now?
Well, the consumer price index, which is what mainstream economics and the mainstream media consider to be inflation. In other words, how fast is the price of what you have to buy at the grocery store or your car or whatever going up? That doesn't give you the whole picture, because it ignores financial asset prices. So what's happened in the last 3 decades is the central banks of the world have been creating lots of new currency and dumping it out into the economy. But instead of just going into everything across the board, that new cash is flowing into financial assets. In other words, it's causing stock and bond, and to an extent real estate, bull markets in which the prices of those assets have been going through the roof. So in effect, we're seeing massive asset inflation and minimal consumer goods inflation. Since the government only measures consumer goods and reports that as inflation, we think there's no inflation, but really there's raging inflation if you include asset prices in your calculations. And one branch of the Federal Reserve just did that lately. They included stock and bond prices in their calculation of the CPI, and they got something over 3% on average now, which is about twice as fast as what the government reports for its standard CPI. Now, if we had 3% inflation right now, we would be feeling like we were in crisis. The Fed would feel compelled to raise interest rates, and bond prices would be tanking, because a 1.5% or 2% bond yield in a world of 3% inflation is a negative yield. Why would you own something like that? Nobody would. They'd be selling those bonds as aggressively as possible, and central banks would have to be buying them up with newly created currency, which would cause more inflation. You know, we would be in a kind of a death spiral, really obviously. But that's the reality of it. You know, that's actually what inflation is, because you should include asset prices in your calculation of the cost of living, because if you need to buy a house and house prices are going up, well, that raises your cost of shelter. If you want to save some money by investing in stocks and bonds, and the price of stocks and bonds are going through the roof, that raises the cost of that aspect of living for you, right? You know, if the cost of investing goes up, that's a cost, because investing is part of living. So we should be looking at asset prices when we talk about inflation. And if we were using asset prices as part of our inflation measure, the numbers would look very unfavorable to the point of being, kind of grim and crisisy. So I think people who want a clear picture of how the world is going right now should look at it that way. They should think of asset prices or as an aspect of inflation. In other words, when stocks spike, that's the same thing as saying the dollar plunged versus stocks. So as the dollar plunges against more and more things, for instance, cryptocurrencies came out of nowhere, and they're kind of sort of competing forms of money, but they're spiking against the dollar, which is to say the dollar is plunging against these new forms of money. Look at the world in that way. In other words, what is the dollar plunging against? And you find a lot of different things. Which implies that the dollar is actually falling in value, maybe at an accelerating rate, but certainly at an unacceptable rate right now, and that we are having inflation, and that we shouldn't be complacent. We shouldn't be thinking, oh, things are great, when they're really not great, because accelerating inflation is usually the sign of an impending crisis. So we will get there. We will have that crisis that is due to accelerating inflation at some point. And, it could easily be soon, or it could be that it takes us a little longer because central banks just up the ante and keep on pumping out even more and more money. And that papers over these problems that are only obvious if you dig into it. They're not headline news, so most people don't know about them. But Dave, guys like you know about them because you're paying attention to the stuff that goes on beneath the surface, and your listeners are presumably aware of this stuff because you and your guests talk about it. That's not a critical mass yet, but eventually, when enough people figure it out, they'll start acting accordingly. They'll dump their dollars by buying gold and silver, which is really just a trade of different kinds of money. You're getting rid of the bad money and buying the good money. Or they'll buy other kinds of real assets like energy companies or mining companies or well-chosen real estate. That's what happens when people lose faith in a currency. And the tail end of the process, the blow-off part of the process, is called a crack-up boom in the Austrian School of Economics. That usually leads to a gigantic collapse. So I think there's evidence that we're well into something like that now based on what asset prices are doing, and which is to say what the dollar is doing, how the dollar is falling against all these things. So we could be close.
Yeah, so basically the government, the Fed, what they do is they leave certain information out of their statistical numbers, just like the unemployment numbers. All those people that aren't looking for work, well, they don't want a job, so we're not going to count them. For the unemployment numbers, we're going to, count the part-time job as a full-time job. They manipulate the numbers. The same thing with inflation. Well, let's not count all of this. Now, you said something very interesting. And I started to think, as these asset prices move up and, this is inflation, housing's moving up, the stock market's moving up, Bitcoin is moving up, means the dollar's declining. Wouldn't gold and silver move up the same exact way then?
They absolutely should. And if they haven't, it's kind of a mystery, because why would cryptocurrencies soar? And why would real estate soar? And why would stocks soar? Well, these are things that rich people tend to buy. And why wouldn't rich people be doing historically what they do and be buying precious metals at the same time? If you look at basically every financial crisis since the days of the Roman Empire, gold and silver went up dramatically versus the currencies that were being mismanaged by their governments. This time, gold and silver still are up. If you look at, for instance, gold in the year 2000, it was $200 and some an ounce. Here, 18 years later, it's $1,300 and some an ounce. That's a nice run. Gold has done a good job of protecting against fiat currency inflation, but it's not getting the blow off top kind of capital flows that some of these other assets are. I can't really explain that. There are some people who say that it's a manipulated market. Governments are consciously depressing the price of gold and silver, whereas they like it when real estate goes up, so they're not worried about that. They like it when equities go up, so they're not worried about that, because those things aren't direct competitors. They're not other forms of money, so they're not competing with the dollar directly. There's probably something to be said for that. I don't think that's something governments can control in the long run, though, because not all governments are doing it. First of all, you got Russia and China and India aggressively buying precious metals, which means that we're basically putting those things on sale for these governments which have a different idea of their monetary futures. Obviously they intend at some point to use precious metals to back their currencies in some way. In other words, even if it's just psychological, if it's not some kind of numerical relationship that they establish, their currencies are still perceived as being more solid if they've got huge amount of gold and silver sitting in their vaults that they can use to back up their currencies. That seems to be their plan. And to the extent that they keep doing it, that they keep taking gold and silver off the market, then that improves the supply-demand characteristics of the markets in the West for precious metals. So at some point, that the supply and demand calculus becomes so favorable for gold and silver that they just take off, and we make back all the lost ground. So we could easily have a parabolic jump in precious metals as part of the monetary reset that has to happen. It could easily be that the U.S. government just announces one Sunday night that we're now back on the gold standard at $10,000 an ounce, which means the dollar is worth 1/10,000th of an ounce of gold going forward. So the people who've been sitting with their precious metals and waiting would be vindicated. And all of a sudden, just overnight, would be a lot richer than they were before. That could be the way it goes. It seems counterintuitive, though. You'd think people would be anticipating something like that. But it could just be that everybody's looking at the headline numbers in financial assets and not paying attention to the underlying cause of the blow off top in financial assets. And eventually they will come around to that kind of thinking. And it could be that cryptocurrencies have drained an awful lot of capital into, for instance, Bitcoin that would have gone into gold and silver, which is in the long run good for gold and silver, because at some point, cryptocurrency holders who have huge embedded profits will get worried about the volatility in that market, and they'll look for something else. They'll look for a way to cash out some of their Bitcoin and put it somewhere that's a little bit more stable. And gold and silver are the prime candidates for something like that. You're not going to buy Tesla stock at an all-time high in order to get stability, right? If you're selling your Bitcoin and trying to lock something away in a safe place. But gold and silver, they'll do that for you because they've done it for 3,000 years. So at some point, gold and silver become favored assets in this market. And I'll go out on a limb and say sometime in the next 3 years, precious metals will be the best performing asset for at least one of those years. It could be 2018. We're rising right now in precious metals. They've had a good December and a pretty good beginning in January. And if that continues, then this might be a good year for precious metals. And if it's a good year for precious metals, that might get people interested. That becomes a headline thing. When gold is the best or one of the best performing assets in the market, people see that, where they wouldn't have seen gold, any kind of a headline about gold, at least in the past. And that gets them excited. Most of the market is basically made up of trend followers. When something is rising, that looks good, and they want to buy some of it. And so you need something to start rising off of a bottom to bring in people who are not just, deep value kinds of investors. Those are the guys buying gold right now, the people who are looking around and saying, well, there's only one undervalued asset, only one thing that's had a big correction and hasn't spiked subsequently out there, and that's gold and silver. So those people are buying precious metals right now. Let that push the price of gold up to, say, $1,500 an ounce, which it's been there before. It could happen easily this year. Then all of a sudden it's headline news. It's the best performing asset in the market. And then you get the momentum guys coming in, and it gives precious metals another leg up. And then you get the monetary reset, and then we get the parabolic spike for precious metals. So that's the optimistic gold bug scenario, and it's not in any way unrealistic. That could happen easily, and I would say that some variation of that is even probable in the next 5 years.
I mean, of course, this happened to Bitcoin. I mean, if you really think about it, 1 minute it was like 200, 500, 1,000. I think it hit 2,000. People were like, oh, it's a bubble, it's going to pop. That's it, it's done. And all of a sudden, it just started to take off, and people were shocked and surprised at how quickly it was moving up. So gold or anything could do the same exact thing. I don't see that as an impossible type of scenario whatsoever. But what I wanted to ask you is the Fed actually planning for a recession? Because in their latest transcript, it reveals that the entire market will collapse when interest rates rise. Now, they're raising the rates very, very slowly right now because they were very low. And, a lot of parts of the world, they're in zero or negative territory. But if we go back to 2004, prior to 2008, they started to raise the rates like in 2004 to 1.5, 2005 to 2, 2006 to 4. And the mid part of 2006, they continually increased it up to 5.2%. And then all of a sudden, at the end of 2007, they started to drop the rates to 4.5. And then they did it quickly in beginning of 2008 to 3, the middle of 2008 to 2. And then boom, the market crashed in October. So they knew they kicked something off at the end of 2007. Do you think the same thing is happening? Do you think they're preparing for some type of recession, and this is why they want to bring the rates up a little bit to kick it off and then bring the rates back down?
Well, yeah, here's the Fed's dilemma. They know that a recession is coming eventually because they always happen, all the way back through financial history. There's been a business cycle in which you get some growth for a while and then imbalances build up and you get a recession, to flush out the bad ideas that were put into place towards the end of the previous expansion. They know that's coming. So they want to raise interest rates in order to have some ammunition for lower interest rates. If they start out at zero, it's kind of hard to cut rates dramatically to counteract the next recession. So they would like 4 or 5% interest rates, which is historically what they end up with at the peak of a cycle. And then they can cut further down from there. On the other hand, they know that the system is incredibly financially fragile right now. We've got a term that I've used in articles and book chapters is the variable rate world right now, where everybody owes so much debt, a lot of which has to be rolled over and or it fluctuates with the general level of interest rates. So if rates go up, everybody's interest costs just explode. And that's governments and corporations and individuals across the board. The Fed is terrified that if they raise interest rates back to historically normal levels, let's say 5% Fed funds, 6 or 7% 10-year treasuries, that blows up the world. And so they're kind of in a box right now. If they raise interest rates to historically normal levels, they risk creating an even bigger crisis. But if they don't raise interest rates, they've got no ammo when the next crisis happens. And they'll have to go to negative interest rates, which is a whole different kind of experiment. And neither one of those options is attractive for them because either one brings with it the potential for a huge crisis, a bigger crisis than 2008, 2009, and maybe bigger than the 1930s depression. That's what they're looking at because of the amount of debt that we've taken on. So it's not clear how they get out of this because there really is no easy way to do that. They're just dealing with more and more unattractive options as time goes on. And eventually this will come back to bite them because eventually they're going to err on one side or the other. Either they'll keep interest rates too low for too long and we get some kind of what we've got going now, a parabolic spike in asset prices that leads to a huge collapse. Or they raise interest rates quickly enough to head that off, but the rising interest rates in, credit card debt and adjustable rate mortgages and prime +2 corporate loans and whatever you think, or government short-term debt that has to be rolled over, all of those things blow up the economy. There's really no safe way to navigate this. So the Fed is in trouble either way, and historians will have a field day with this. They're going to come down so hard on the monetary policy architects of the past 30 years. And there will be entire books written about what an incredible mistake it was to beginning in the Greenspan era to just bail out every financial player in sight and never let the system reset again. And that's basically what we're doing right now. We've told the big banks, go ahead and take any risk you want, grow as big as you want. And if you get into any kind of trouble, we will find a way to bail you out. So we've created a system that's guaranteed to collapse at some point. And the Fed may or may not know this because that's not really part of their models. Debt really isn't that big of a deal in their models. But the guys who are actually running the numbers and doing scenarios know that there's the potential for a crisis out there on an epic scale.
So when this reset hits and when we enter this recession, will this be like 2008, or have they made it a lot worse and this is just going to be a disaster for the everyday person on the street?
Well, we've taken on huge amounts of new debt since 2008 at every level. So if 2008 was due to excessive debt and it was an insanely scary crisis that required experimental monetary policy, then the next one is liable to be commensurately bigger and scarier, just because the numbers are so much bigger. The U.S. government doubled its debt. China quintupled its debt since 2008. Europe has increased its borrowing at basically every level of its society. Japan's government debt has soared. So we owe a lot more money. So the potential for this crisis to metastasize into something that's really unprecedented is definitely there. We could have the biggest financial crisis ever, just based on the numbers. Or we could have some kind of a quick monetary reset that gets us out from under this, but at the cost of impoverishing a whole generation of savers. We'll see. It's not clear what they choose. But it is pretty clear that these numbers don't allow for a pain-free exit from the mess that we've created for ourselves.
John, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
I run dollarcollapse.com, which is a site that covers stuff like this. And my most recent book, although it's not that recent anymore, is called The Money Bubble, which was published in 2014, but made a lot of predictions that are just now coming true. So the book is actually more timely now than when it came out. And that's available on Amazon.com or any online bookstore.
All right. I'll include all the links at the bottom of the video to make it easier for everyone. I'll include the link to your site and to your books at the bottom of this video. So if anybody wants to buy the book or go to your site, they can just do that. John, once again, thank you very much for being on the X22 Report Spotlight. I really appreciate it.